It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, it's the Real Estate Breakfast covering the Australian property market for you from Albury to Hobart. There's a couple of different destinations, and good morning if you are in either of those locations. It is a Thursday, May the 28th. Now, the early signs of a housing market correction in Australia are becoming harder to ignore. And since the RBA began increasing interest rates, borrowing power has been reduced significantly. We know that. And confidence has clearly taken a punch to the wallet. Auction clearance rates are now falling as buyers and sellers struggle to agree on realistic price expectations. That is always going to be a problem in this type of market. Some economists are saying prices could soften further. Could? I think there's no doubt at all that they are likely to soften for sure. But nobody really knows where the bottom of this is. All we can do at best is to speculate. And the balance of power, it has shifted away from sellers, and buyers are becoming far more cautious and financially disciplined, which is code for they are in no hurry whatsoever to transact quickly. So off the back of that, let's go to Sydney, a city in the epicentre of what is going on, and catch up with Margaret Lomas from Destiny's Solution. And Margaret, you are back from tripping around on a boat.
I've been everywhere. So I began in Japan, sailed up to Alaska, finished up in Canada, flew down to Mexico to visit some friends, and then came back home via San Francisco.
Well, since you've been gone, things have gone sideways.
They certainly have, and I've been all over it. If the present government is attempting to deal with the issue that home buyers are facing getting into the market, this absolutely is not the way for them to do it. You'd like to think that before such big announcements are made, that the government is going to consult with industry, that they're going to do the proper modelling, they're going to work out exactly what the intended and unintended consequences are of proposing such moves.
Yeah, the budget has certainly been a talking point here, and with a lot of commentators, including economists. Getting back to the market, the auction clearance rates around Australia, they are still sitting at relatively soft levels. While Sydney and Melbourne saw a slight improvement last week, the numbers are still well below the boom time levels that we saw in 2021. Brisbane has weakened further, while Adelaide continues outperforming most capital cities. So yes, they're a long way away, those clearance rates, from those boom times in 2021, which was at 80%.
And I think what we're seeing happening here is investors and even home buyers are adopting a wait-and-see attitude. These auction clearance rates dramatically turned when the first whiff of what might be in the budget came out. So that was several weeks ago now. And then on budget night, when the announcements were made, I think everybody just went into silent mode and decided that rather than take any kinds of risk before we know the detail, that they might just wait and see where it all heads. And it's interesting, isn't it, that even though these announcements were made, we don't know the detail. One of the biggest problems that we have in this country today is undersupply, and we also have a market that is so unaffordable in our larger capital cities that even with every measure you can imagine to try to make the road a little easier for first home buyers into the market, we are years and years and years off the market becoming affordable enough for the average income earner to be able to buy into that market. So I guess the biggest issue that I have with this budget is that it proposes to take away aspiration from so many parts of our country. Young people wanting to get ahead, investors wanting to plan for their own retirement and not be a burden on the country. It takes all of that away for a result that can't be confirmed or even modelled correctly, and for a result that's probably not even going to happen.
Yeah, and even though buyer demand has softened, having a look at just where we are at the moment, Australia still has a major housing shortage sitting underneath the market. Migration, how many times have we been talking about that? It remains still strong. And hundreds of thousands of additional people, they will still need somewhere to live over the next few years. Construction activity, yes, it is improving, but supply is still struggling to keep pace with that population growth. And that is why so many economists don't see a property crash unfolding. How can you? Because the migration is out of control as well.
And let's think about where all this leads. So we have people pouring into the country at a rate of knots. We have an undersupply of property almost everywhere in the country. We suddenly have a huge demand on the rentals because people can't even find the property to buy if they could afford it in the first place. We have considerably less landlords who are now unwilling to enter a market that not only has changed, but where we know the changes can happen at any time. So suddenly we have less rentals available as well. What happens next? Rents skyrocket. And then all those people who want to get into the property market, even if prices moderate, they can't afford to save the deposit that they need because all of their money is going to rents. You can see where I'm going with this, can't you? It's just like this vicious cycle, and there's just no way to break that cycle with the current policies that are being proposed. And all I can see happening out of the removal of negative gearing for property investors in established properties is that we're going to see all of those developers now come out of the woodwork selling overpriced properties in far-flung suburbs that have got absolutely nothing going for them in terms of their capacity to grow over time, selling these properties to people who are buying them just for the tax benefits. And those same people are going to end up owning these properties that there's no secondary market for or reduced secondary market because investors aren't going to be buying established properties. So, the whole thing is just so badly thought through. Whether you like it or not, investors are part of the solution. They aren't the problem.
That is so true, and off the back of everything that you're talking about, especially for first home buyers, including young professionals earning strong incomes, Australians are starting to question whether traditional housing is worth the financial pressure anymore, which is a fair point because what was once mainly associated with retirees is now attracting younger Australians looking for this flexibility, some more freedom and lower financial stress. And I kind of get the whole argument to this because for some, it's a temporary problem. For others, it's becoming a long-term lifestyle decision as housing affordability continually challenges even high-income earners. And you might have even seen this, Margaret, a few days back. Here's a lawyer with a lawyer's income deciding to live in a van.
I did see that article, and while it proposed that many professionals are now deciding to become mobile and live in caravans, I'm not sure that that really is such a big thing. A lot of my cohorts are lawyers and people in those kinds of professions, and I don't know any of them who have decided that they would like to live in a caravan. But what I do know is that many young upwardly mobile professional people today are choosing to rent vest. So what they're doing is they're renting properties in the area where they want to work. They're renting those properties that would otherwise cost them a lot of money to get a mortgage on, and they are choosing then to rent vest and to buy their property portfolio elsewhere. They might decide to buy in one of the capital cities that is more affordable. They might decide to buy in large regional areas. And the plan is for them to build a portfolio of properties large enough so that when the equity grows, they can sell up, take the equity, and then invest in a home of their own with a much lower mortgage. Well, of course, that's all been stymied now by the budget. And these same people now are deciding that is it really a good idea after all? Because not only can I not get those negative gearing benefits, which are valuable to people in higher incomes, but at the end of it, half of my equity is going to be taken off me in the form of capital gains tax.
Yes, and just before I let you go, Margaret, this morning, I do want to talk about the interest-only loans, which are becoming more popular again as higher interest rates and living costs place more pressure on Australian households, because some borrowers are considering switching from principal and interest repayments to interest-only loans to reduce monthly mortgage costs and create short-term financial breathing space. That's what they're going for, is they're going for that breathing space. The main advantage of interest-only loans is lower repayments and improved cash flow. And on a $500,000 mortgage, borrowers can potentially reduce repayments by several $100s per month. I know you've got an opinion around this.
Well, I've got an opinion on everything, as you know, but you say the main advantage is lower repayments. I'm going to say that's the only advantage, because there are many disadvantages for people taking out interest-only loans. If we are in a period of time where property is growing very rapidly, then maybe an interest-only loan makes sense, because you're going to gain equity through the rise in value of the property that you're buying. But if we're entering a time when we're not sure what's happening in the property market, when investors are waiting and seeing and taking a lot of heat out of that buying pressure in the market, which typically makes a property grow in value, then it could be a disaster. Think about the impost on purchasing in Australia today. A home buyer faces many costs, such as stamp duties, which are very high, conveyancing fees, maybe mortgage insurance. And once you add all of that up, it's usually a big chunk of your deposit that goes to just the costs. If you buy a property and only pay interest on the loan, meaning you're not buying any equity through loan repayments, and the property market stagnates and doesn't grow very fast at all, then you risk coming out of that deal way behind the eight ball, with all of your deposit having been eaten up in those expenses, and you could end up coming out of a property like that with nothing. I just think it's a terrible idea, and I've always said, harshly I know, that if you can't afford to make P&I repayments on a loan to buy a property, then you can't afford to buy a property.
All right, we'll wrap it up there. Margaret, great to catch up with you once again on the Real Estate Breakfast. Enjoy your Thursday and talk again soon.
Thank you.
Decode the property market with insider knowledge and insights to better navigate your real estate journey.
By using your superannuation for the deposit, you were able to put down a much larger upfront payment and keep the overall mortgage smaller. So just talk through all of that.
It's quite difficult when you think about the average price of a house or a townhouse. Your super has been accruing and getting higher every year. So you've got a pretty good lump sum in there. If you can utilise that as your deposit, you can then get a mortgage using a much larger deposit, which is a much smaller mortgage overarchingly.
This would make it easier for first home buyers to get into our marketplace on the concept that investors wouldn't like this CGT proposal, and so they might think about selling their investment properties around the country. The looming higher tax rate might actually make investors sit still.
That balance of those investors to continue coming into Perth, yes, there have been a number of investors pivoting, but how concerning is all of what you're talking about for those investors to keep coming into Perth?
A couple of years ago, they would have paid in the order of $300,000 to $400,000 for a single residential dwelling on a site down there. They're at now $600,000, $700,000. Will those investors exit our marketing and increase our supply and potentially making that marketplace slightly vulnerable to value correction? Or will they hold knowing that they've made that gain and they don't want to realise capital gains tax?
We connect you to the best real estate information across Australia. The Real Estate Podcast.